Welcome. This is part two, the final part of what I learned from search funds class. In the first video, we saw the four aspects: how to search for a company that you will become the CEO of, and how do you acquire it. So that was covered, these two topics were covered in the first video. The second video is this video is going to talk about how do you run the company that you just acquired, and eventually how do you exit it, how do you sell it. And here again we got good examples from real life. Tyler Coates came, who's the current CEO of Falcon Ambulance, and we had case studies where we learned about his experience from that case study. And Peter Kelly also came and shared his experience about his experience, and we had case study for both of them. So it was good real life experience to learn from people and who have just graduated, and these case studies are fresh. It's not 20 years old and people are no longer relevant. So that was a fantastic part, to not only learn from the case study but also then get a chance to talk to the real protagonists in both of those cases. So these were the two main people that we learned from, and I have in this image their LinkedIn profiles, so you can actually go and find them out. So what were the key insights in this second day? So this is a two-day session at Berkeley. The second day we learned about running the company that you acquired very well and also exiting it. So stepping back, why do people do an MBA? And the professor shared three good reasons, and I think that was the best way to put it. First is to have some point of reflection where you step back and you reflect on where do you want your career to go. So it's a point of reflection where you take time out for yourself. If it's part-time or full-time, it's a point of reflection to step back and get a direction towards the next steps of your career. The second one was it helps you get a significant lift up in your current path, because now all of a sudden you are a better partner to your product manager. If you're an engineer, you're a better partner to your product marketing person, you're a better partner to your product finance. So you understand the business well, so you are significantly valuable, and so your career significantly moves forward. What I have seen personally in my career and also with so many of my colleagues is that the fact that they were enrolled in an MBA, very soon they were promoted, or they would be promoted in the second year, or definitely by the time they graduate. So there is definitely a career promotion and boost. That's the second major reason. The third one is when people pivot completely. If you're an engineering leader, you could pivot into marketing or finance or even strategy. So there's so many ways in which you can pivot, not just in your industry, but also pivot industries altogether. Like in this case, if you go and acquire a small startup through search funds, you are all of a sudden in a different trajectory altogether. So Jen Simon did his MBA in 1994. So many years ago, right? 30 years almost. And so that he also shared that the professional life is quite important because it is a big source of money. Your current professional life is a big source of pride, and the value that you bring to the table by the impact that you have for the work that you do is very important. To have something meaningful that people like in some way is defining your ego, which is important. So why did he share some of these things about his personal life? Why do we do an MBA? Remember, the goal of Search Fund is to be the CEO. So he's really asking us to reflect, what do you really want to do, right? And if all you want to really do is teach, then don't deviate too much away from that main goal. Or if you really want to become a finance professional, or if you want to be an engineering leader, don't deviate too much away from it. Because what happens is if you go too deep, like in this case number 2, and there's path number 1, then a straight line is the fastest way. right? This black line, if you see, is the fastest way to reach from point A to point B. But you could take a blue line, which is a slight detour, or you could take the red line, number 2, which is a much bigger detour. So he really wanted us to, before he started day 2, step back and reflect as to what is your true north, what is your goal, what do you want to do, and reaffirm the search fund. The true north is for someone to become a CEO. And it prepares you. The process of creating a search fund prepares you for an industry experience. It changes you behaviorally. It personally transforms you. And so that is a process. It makes you ready for being the CEO. And where does the money come from? The money comes from family offices in these search funds. They really want direct exposure to where their money is going, and they have large amount of money to invest in. And if they really want to make better returns than market index fund averaging, they have to have these kind of bets that have higher returns, higher internal rate of returns. And so that's where the money comes from. Accelerator, we've talked about this in the day 1 part 1 series, so we know what that is. And he shared some really good tips around, like, hey, if there's a very, very small company that you acquire, then it really lacks a lot of structure to scale. So you really have to make key critical hires quickly. And the path to success, to getting those investors to not only give you the initial search fund, which is the 10,000 per person, but eventually back you up with 500,000 per person, is when you've updated them and they have been in the loop, so that they can actually be a good reference to you, not just for their own money, but they'll actually provide a reference letter saying, hey, I've been in touch with this searcher and he's made a phenomenal progress. So getting references is important for actually raising the money. And remember, money has faces, so you really need to build those relationships with these people. So using your professor is a good way to build reference letters so that people can have credibility in you and actually put in a large amount of money. And you can use your network, the MBA network, the search fund network, the professors network, to actually find out who the funders are. And times when these people don't really invest in you, even after they've given you the initial acquisition, initial search money, but they don't give you the acquisition money, is because maybe they don't like the company. Maybe they don't have too much exposure in that industry. Maybe they don't like you. So those are the 3 reasons. And he says that private equity will never be in this space because they have a specific defined criteria where they will only do investments in certain areas where they have a bench strength to actually take that on and have deep expertise. And then also the ticket size is just too small for them to make any difference. So private equity will never get into the space. So once you have acquired the company, that's the key learning from this second day. And we've gone through in this a case study of California Miracle, which actually is Falcon Ambulance, I think. And Tyler Coates is the CEO, is a real person behind that case study, but the case study was called California Medical. And he shared a really good insight. If you see this person in green, you have to not only entertain the lead, the LOI person that you have now engaged with, but you want to be constantly searching and building your funnel. Only then can you, if you remember from part 1 of the video, you have to have lots of connections, you have to have lots of leads, you have to have this funnel built. And without doing this thing in parallel, it's going to be very hard. If you just focus on searching but don't really entertain the lead, then the lead will never convert. If you just focus on the lead and the lead falls through, then you have no backlog. So building that ambidextrosity of doing multiple areas is very important. And in case of Tyler, he really built good rapport with the family who was trying to sell the business, and he actually was very successful in buying that company. And his reason primarily for buying that company was that the industry had a huge tailwind. the medical ambulance industry, structurally life expectancy was going up, so more and more people would need these healthcare services. So he really felt that the industry was strong. The barrier to entry, according to him, was high because big customers won't work with small players. Small players won't have operational leverage. So he was trying to go into this market with this industry and actually expand. And his key insight was people are looking for impact. So giving them purpose as to why they're doing what they're doing is important. And the key learning from him for me was the industry that you choose is important. Industry that has a tailwind like healthcare, education, technology is very important. Otherwise, you're constantly swimming upstream, right? So then the key question is like on day one, now that you've bought this company, how do you prepare for it? What would you do on day one? You really need to not be impulsive because there's lots of new things you have to do. You've done a lot of due diligence outside, but you're going to learn a lot more when you've started running this company. So you need to do a lot of deliberation, a lot of analytical thinking. And, a week before on a Friday, there would be a different owner, but now it's on Monday and you are the new owner. So how do you make sure that you land in a way that is effective? So what do you do on day one, right? So he says building allies to make sure that you have connected with some of the key stakeholders, key leaders, and you've done a lot of role plays with your investors to find out what kind of questions you will get asked on day one. You probably also want to do a meeting with the entire company, and you want to talk to your customers, you want to talk to employees, you want to talk to key managers, executives. And the first question they'll always have with a new leader is, am I going to be fired? That's a key question. So you got to be very careful what you say, because if you say no, but then you do end up firing them because you found out that the accounts were inflated, the company's doing pretty bad, you just lost trust permanently. But if you say yes, that doesn't work either, because most of them have started looking for a job and now you have a big problem in attrition. So you will get asked a lot of questions. You have to do role plays, prepare for it, have an agenda, have questions and answers ready, have a plan for the first day, have a plan for the first 100 days. Ideally, as a learning agenda, you want to learn. Typically, when you would have bought a company that's doing very well, generating free cash flow, and so you don't really need to urgently make changes unless it's a lemon company. Then you'd have to make some more changes. So preparing for who you would talk to, your employees, your stakeholders, your customers, your executives, and making sure that you send the right signal to them is very important. What tone you want to set for them, what kind of culture. It requires a lot of planning. So that was the key learning, preparing for day one, having an agenda for 100 days, and going in with that learning mindset. And using the current leadership in staging conversations or having those client conversations so that the client and customers actually have confidence in you and your leadership that you will do well. Maybe you want to retain some of the old management and old leaders and have them have a earnout which says, hey, you will stay until this period and do XYZ until you've actually ramped up. So having acquired a company, what do you do initially is very critical. You want to hit the ground running, you want to have the right tone, you want to go with the learning mindset, and you want to find out quickly what changes you want to do in the first 100 days. The second one was, actually this is the same person, Tyler, right? Naval Academy. He was in charge of the nuclear submarine in 2013. Went to Stanford Business School and then acquired this ambulance company, right? So it's really important as to how a lot of leaders from different sectors can come in and actually hit the ground running and become an executive leader. So this is the path to CEO. So Tyler Coates was super influential, and he actually shared this insight in the Q&A. He shared the healthcare transportation hierarchy of needs. Look at how simply he was able to convey that, hey, the different hierarchy of needs and where his company falls into this industry. So doctor's appointment is one, the lowest level of need, and then wheelchair support, and then stretcher lying flat support, basic life support, which has 2 ENTs, critical life support, which has 1 nurse and ENT, which is also regulated, and then emergency, so there's different levels, and he's trying to find out where he stands in his company and where he's actually going up or down. And he found out many issues as well. He found out that people recently, as soon as he had joined, there was a delay and even a miss in certain paychecks being delivered. And so he shared how he spent time in building the right systems and processes with HRIS and ERP systems to make sure that no one had a lost payment. And digging deep, he also found out that several times in the past, these workers actually had a miss in payment, and that required them to have lots of manual processes, follow-ups, and the delay in money coming into their bank account. So he actually shared some really good insights as to not only where he stands in the industry, but also how he solved some of the initial issues and how he invested in these tools to make things better. The second aspect that was really interesting was, what are all the partners you need? And the biggest partner you need when you acquire a company is a legal counsel. There's lots of documents that you will want to create, and you want to make sure that you are protected with reps and warranties, so that if things don't turn out to be as promised, that you have a downside protection. So legal and lawyers have a huge role to play. So building a legal team, ideally with people who have had search fund expertise, and a lawyer who has done some private equity work, or a lawyer who has done some search fund work, is ideally the best, because they'll not charge you without a deal, because other lawyers will charge you by the hour, but the search fund person knows that, hey, if there's no deal, then there's no bill. And so you want to get search fund lawyers, and you want to make sure that your relationship with your seller doesn't deteriorate, because the lawyers come in place and they start writing things that typically assumes lack of trust. And so you want to make sure that you're in charge, and that you both are also, as a buyer and a seller, meeting separately and making sure that you tell the lawyers, and then the trust remains. And you educate the seller that, hey, this is required, otherwise you'll never be able to sell this company. And so educating them and building a strong partnership with the legal team is very critical. Look at the number of documents that you'll end up creating. You'll be creating a PPM, which is a private placement memorandum. It's the first document that you create to attract money. Then you'll create a shareholder agreement document. Then you'll create an acquisition document. Then you'll create a sales and purchase agreement document, which has inventory, and then you'll create a letter of intent. So there's so many documents that you create, and you need a lawyer for all of this. So building a strong legal partner is important, super important. And knowing the difference that, hey, buying an asset versus buying a company is two different things. If you buy Netflix as a company, you can buy its equity, which comes with a lot more than its assets, or you could just buy its assets, like let's say it's movies. So if you buy the company and equity, you actually have all the customer connections and all of that, and you also have part ownership of the assets that the company has. But if you just buy the assets, then you don't have all of the things that comes with a contract that's with the company. And it's not, the contract's not with the assets. So that was a key distinction that I learned. So lawyers, super, super important. And finally, when you do your first meeting, anchoring as to how you are thinking of valuation, what kind of multiple you have, that initial anchoring is very important. Because if you say you value companies 6 times EBITDA, then that's a base. You can never go back from it. Even if you think that you want to buy this company for 5 times EBITDA for various reasons. So initial anchoring is important. You want to really find out if the seller is a real seller in the first meeting, and that you both speak the same ballpark. Because if you want to buy a company 6 times EBITDA and the seller wants to buy sell the company at 6 times annual recurring revenue, ARR, you're in two different ballparks. So having the same ballpark for the buyer and the seller, getting the second meeting, assessing if it's a real seller, has a real reason to sell, super critical, right? And doing their due diligence and paying like $25,000 for actually counting the inventory, checking the accounts, checking the quality of earnings, doing deep diligence is very helpful, because you don't want to be surprised after you bought the company. So paying that money is helpful. So use the acquisition fund that you have to actually do the due diligence. And when you do the LOI, you actually get a lot more deeper insights of the company. So you learn, go even more deeper, and learn, right? And you'd have to hire certain key people. And this diagram has a good distinction between what venture capitals, the thing that they have the most is they expect more than 20% return, and they have a lot of software background, meaning they're invested in a lot of software. Private equity, they have a lot of money, deep pockets, and they have a specific niche in which they'll invest. Search funds actually has the best of both. And so that's where, and so the return expectation is also very different, right? So if we were to recollect, this is 20% return on investment that the VCs expect. Private equity is between 15 to 20%. Actually, 15 to 20% is search funds, and this is between 10 and 15% is private equity, right? Something around that ballpark, right? Which we saw. There's different return expectations, and you need different kind of companies to acquire, right? First 100 days is just learning. You're just asking questions, meeting people, understanding their stories, finding out where the money is actually being used. Make sure that every expense that the company does requires your signature or requires your approval. Find out where the money is flowing. And the way you do it is find the flow of cash. Find out the real source of power, the key people that you've not only done in your due diligence before you acquire the company, but even outside. You don't want the good people to leave. That's the real reason. And then get early wins. The professor shared a really good example of one of these CEOs who actually found out that the employees were just frustrated because they wanted a microwave in the kitchen and no one was giving them the microwave for some reason. So the first thing he did in his first week is he walked in front of everyone with a big microwave in his hand and established a pretty good trust and win, and won the hearts of people. Say, hey, they wanted a microwave, give them a microwave, right, in the kitchen. So establish those early wins, build those early wins quickly, and set the right culture. If you don't want gossips to happen, then don't do gossips yourself, right? And once you've done those due diligence and had your conversations, think about the future. Who's going to disrupt you? Who are you going to sell this company in 10 years, 5 years? And what would they want this company to be, right? Who's going to buy you, right? And you're the one who brings energy to the table. So as a CEO, you will be solving a lot of problems. So be ready for that, right? And how the money will come, in terms of investments, once you've done, you would have to raise the acquisition fund. You will have to use some bank notes. You'll have to have some equity notes. You'll have to have some seller notes. So higher the risk that you have for the company that you're investing in, the conservative the balance sheet that you want. That was the key insight from this. And if the expectation is a higher return, then you want to buy it at a lower price, or you want to sell some assets. Otherwise, it's very hard. But in this case, I think Lemon Company, or the company was actually pretty bad than what was originally intended. It was Peter Kelly's example, where he actually got into this company, and it was one of the case studies, where he bought a company whose EBITDA was overstated. That was the biggest issue. He was told it was 1.7 million EBITDA, but it was actually 0.7 million EBITDA. So he actually, instead of paying a 4x multiple of 7 million, he ended up paying 11x multiples. The EBITDA was overstated. The working capital was actually much worse. Instead of 35 days, it was 45 days. The revenue was actually not growing but declining. So that was bad. Inventory was misstated. It was 40% lower. Management was average. And worst of all, his partner left when he had to just he just bought the company, and the partner decides to leave when he was just going to sign the deal. So his co-partner decides to leave. So what he does, Peter Kelly finds out the biggest problems and starts solving them one by one, prioritizes them, hires a CFO so that he can help by establish and build cash flows, sold off inventory, focused on core business of respiratory and rehabilitation, just focus on that high margin business. Everything else was given out, executed like a rock star. Eventually then hired SVP of sales, and then he hired A players after A players. So hiring talent is very critical. And how would you hire talent in this age? A lot of people want autonomy. They want to have an impact. A lot of companies don't give that opportunity. So selling for that is the most easiest way. You don't have the deep pockets that these big corporations have, so that's your best bet. So he actually hired people. So he really turned the ship around in a pretty big way with the SVP of sales that he hired, had a straight talk with the bank saying, hey, look, we have to restructure. And he started selling things, got a little bit more time, improved the collection process that could be improved, focused on key areas, and he actually improved the sales and eventually improved EBITDA from 7 million to 10 million to 20 million to 25 million. So he actually turned the ship around. It was a complete lemon, and he completely turned it around. So that was just amazing. And one insight from him was, when you are doing layoffs, cut deeper than you really need to cut, because you can't do these layoffs twice. You will lose 100% trust. People will leave non-stop. And don't get into a turnaround situation, because it's only possible with seasoned executives that they can actually have a chance to win. So don't get into that. Exit. So the third part was running, which we just covered, and then exiting. What would trigger an exit for you? You just bought this company. You would have probably run it with certain expectation. Let's say 35% IRR. The return expectation would be higher when you're an unseasoned CEO. Lots of risks, so they want higher return. But eventually, once you've run the company 5 years as a seasoned CEO and you've actually grown revenue and EBITDA, then their expectation return should go down. So that could be one of the big reasons for you as a CEO saying, hey, why am I earning 35%, let's say, IRR for these investors? They should have lower expectation now so that you can actually make more money. So money could be, liquidity for you as a CEO could be a reason. Return expectation could be a reason. It could be that you want to spend more time with your family and go slow, or you have a strategic buyer that would give you much more money and that you can exit now and actually start another search fund. It could be industry changes, there could be regulatory changes, there could be so many hosts of reasons. And ideally, a CEO who has a good board, they actually realize all of this. They might even, like, after 4 years, give more equity, and many things they could do to make sure that the seasoned CEO continues. But there could be many of these reasons, including health, for you to exit. So when that happens, ideally your board is on top of this, and they help you to either move on or continue. So that's the key reasons for exit. The two main players, there's three actually. Private equity could be an exit strategy, strategic buy could be an exit strategy, or an IPO could be an exit strategy. Each of these take much longer. Private equity is the fastest, strategic buyer is second fastest, IPO is the third fastest, meaning you can get to private equity, they have lots of cash, they have a reputation, they will come in and make changes. You could have a strategic buyer who has revenues declining but has deep cash flow, and you have need for cash, so that together both of you are much more valuable. Or you go an IPO. Typical private company that goes IPO without any change has a 30% higher bump in valuation. Why? Because that company is now more liquid. You can buy and sell in that company anytime. So a liquid asset is 30% more valuable than a private unliquid asset. So you get a higher percent valuation even in an IPO. So various exit strategies and various reasons for strategies. Two really good books that were recommended was Outsiders and then Thorndike. I will look that up and put it in the comment if anyone's interested. So these were good books that the professor also requested, actually shared with us for us to read. So that is the end. We've now summarized in this video how to run the company once you've acquired it and eventually exit it and sell it. So when you sell it, now you are in the opposite side. Initially you were trying to buy it and from a seller, so you would see a full circle. So that is Search Funds Day 2, Part 2 of this video, the final part. Fantastic learnings in this book. Hope you all got inspired and understood a little bit more about what the process of search fund looks like and are interested, and some of you are interested. I'm interested in doing search funds, so I'm actually want to hear from you. So if you have thoughts on this, add in a comment and we can continue our conversation there. Thanks.